In this video, we will look at accounting for income taxes with an asset revaluation. In the example that we have taken here, company has purchased a motor vehicle, a car, on 1st of July 20XO for $100,000. There's no expected residual value. The corporate tax rate is 30%. The depreciation rate for accounting records is 20%, and the depreciation rate for tax records is 25%. And both depreciate on straight line basis. 1st of July 20X4, company revalued the car to $50,000. We required to state the journal entries for the year ending 30th June X1, X2, X3, and X4. So in accounting records, X1 year cost is $100,000. Depreciation is at 20%, $20,000, and the carrying value is $80,000. Second year accumulated depreciation is $40,000, carrying value $60,000. Third year accumulated depreciation is $60,000, carrying value is $40,000. Fourth year, at the beginning of fourth year, the asset car has been revalued. The carrying value $40,000 increased to $50,000. And the increase is $10,000. Asset has a remaining useful life of 2 years. Accumulated depreciation on X4 is $25,000. Carrying value is $25,000. X5, accumulated depreciation is $50,000. And the carrying value becomes nil. In tax records, the cost is $100,000. And it's depreciated at 25%. The first year, the tax base is $75,000. Second year, accumulated depreciation is $50,000. Tax base is $50,000. Third year, accumulated depreciation increased to $75,000. Tax base becomes $25,000. X4 year, the accumulated depreciation becomes $100,000. The tax base becomes $0. And the fifth year, the tax base is $0. When we compare the carrying value and the tax base, we can say that the carrying value is higher in the first year by $5,000. So it becomes a taxable difference. Applying the tax rate, deferred tax liability balance becomes $1,500. Second year, the carrying value is higher by $10,000. That's deferred taxable difference. Deferred tax liability balance becomes $3,000. Third year, the taxable difference becomes 15,000 and the deferred tax liability becomes 4,500. Fourth year, the carrying value is 25,000 after the revaluation, and the tax base is 0. Taxable difference is 25,000 and the deferred tax liability balance is 7,500. Fifth year, carrying value and the tax base are nil. Therefore, the deferred tax liability balance should be 0. So the increase in first year, there's deferred tax liability balance of 1,500. That's increased by 1,500 into the second year, increased by 1,500 into the third year, and increased by 3,000 into the fourth year, and then it's decreased by 7,500 into the fifth year. So this increase, 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 and then decrease. So let's look at the journal entries. The first year, we debit income tax expense and credit deferred tax liability 1,500. Then there is depreciation expense of 20,000. Accumulated depreciation 20,000. Second year, our deferred tax liability balance increases by 1,500 and we debit 1,500 for the income tax expense. Because the increase is 1,500 and the depreciation expense is 20,000 and accumulated depreciation is 20,000. In the third year, deferred tax liability balance increased by 1,500. Debit income tax expense 1,500. And there's on accounting records, there's depreciation expense 20,000 and we credit accumulated depreciation 20,000. 20x4 at the beginning of the year, the vehicle has been revalued. So to prepare for the revaluation, we debit accumulated depreciation 60,000 and credit the motor vehicle cost account 60,000. So there was 100,000 and accumulated depreciation is now credited to that account. Therefore, our carried forward balance becomes 40,000 and that becomes the carrying value that is going to be increased to 50,000. So to increase that to 50,000, we debit motor vehicle 10,000 and it's a revaluation. So we credit other comprehensive income revaluation gain 10,000. And this deferred tax liability, because the carrying value is higher than the tax base by 10,000 and at 30% is 3,000 and the income tax expense is 3,000 we debit. At the end of the year, revaluation gain, the credit is being debited and the income tax expense 3,000 is being credited in the other comprehensive income. and the net of that is being transferred to the revaluation surplus. So effectively what we have is debit motor vehicle of 10,000, credit deferred tax liability 3,000, and credit revaluation surplus 7,000. At the end of the year, there is depreciation expense of 25,000 on the revised asset value of 50,000 over remaining useful life of 2 years, and accumulated depreciation 25,000. The deferred tax liability increase is 3,000. Is that 3,000 increase into from year 3 to year 4, 3,000. Credit deferred tax liability 3,000, debit income tax expense 3,000. And year 5, the remaining year, 50,000 asset value is depreciated over 2 years. This is the second year. Debit depreciation expense 25,000, credit accumulated depreciation 25,000. Now that the asset has been fully depreciated in accounting records and tax record, therefore the deferred tax liability balance that was built up, which was 7,500, we debit. That's this balance. And now debiting, which is a built up a credit balance. We debit deferred tax liability and we credit income tax expense. That brings us to the end of the video. Thanks for watching.